everyone, and welcome to the Payments Association Inside podcast. I'm Yalini Pathy, Director at AlixPartners, where I support clients across the payments and wider financial services sector, and I specialize in compliance and business value preservation. I'm delighted to be joined today by Olivia Murphy from Linklaters and Dennis Cheng from Gladius Assurance, both of whom are my peers on the Payments Association Regulatory Working Group, and thank you both for being here. Today, we're focusing on safeguarding in the payment sector, a topic that's front and center for firms right now. With new FCA rules coming into effect in just 5 months, there's a lot for payment firms to get to grips with. We'll also be setting the context around balancing innovation, growth, regulatory compliance, while highlighting why safeguarding is a non-negotiable as the anchor of client trust amongst any other reasons. So before we dive in, Olivia and Dennis, please introduce yourselves.
Thanks, Yalini. I'm Olivia Murphy, and I'm a managing associate at Linklaters in the regulatory team. I have a special interest in payments and fintech more broadly, which is why I'm here today. And I advise payment firms on a range of regulatory requirements, from what licenses they need through to how to prepare for the new safeguarding rules that we're going to chat about today. I, as you said, also sit on the Payments Association Regulatory Working Group alongside Dennis.
Thank you. Thanks, Olivia. Thank you, Yalini, as well. It's great to be here. So I'm Dennis Cheng. I'm a principal at Gladius Assurance. We're a specialist consultancy that really focuses exactly on this stuff, which is CAS and safeguarding. Prior to this, I was a partner at Deloitte, where I spent a lot of time leading clients on the CAS audit as well as advisory work. As you say, I'm a member of the TPA's regulatory working group, and more recently, I've also joined the working group at the FRC as well, as they're developing the new auditing standards for this sector. Just whilst we're on the FRC, I think it's especially interesting right now because as they're bringing the new standards into play, I'm really there to bring, I guess, the voice of the firm, if like the regulated firms who are subject to these audits, ensuring that the standards that's being developed are practical, they make sense. So therefore, on this basis, I'd love to engage with the industry over the coming months.
That's fantastic, Dennis and Olivia. Thank you. So if I take us to the first topic, I know the FCA has been keen to strengthen safeguarding practice in payment firms, and last year's consultation marked a significant step in that direction. Olivia, could you walk us through the FCA's desired end state for the safeguarding regime, why interim rules are now in focus, and what should firms be thinking about in the immediate term?
Thanks, Yalini. So I suppose there's quite a lot to unpack there. And before we get into perhaps some of the details of the rules, it's worth just stepping back and starting with a bit of context. The FCA has been really focused on improving safeguarding practices at firms. And this is why last year it consulted on some really major changes to the safeguarding rules. The FCA's desired end state, so the second set of rules that were thought about in that consultation paper, included requirements for firms to hold safeguarded funds on trust and also to receive customer funds directly into a designated safeguarding account. Because those rules would actually require changes to legislation, the FCA suggested what they were calling then interim, but now supplementary rules that payments firms could implement much more quickly. And it's those interim rules that we're looking at today. And the end state rules have effectively, at the moment, as far as we can tell, been put on the back burner. So there's now about 5 months to go until those new rules go live. And I think an important point to sort of make at the start is that while not everything in the new rules is new, there are some new requirements in there. And quite importantly, by turning requirements that were previously guidance into now actual hard regulation, a couple of things happen. The first thing is that breaches become much more actionable by the FCA. And the second thing is it's actually easier for the FCA to measure firms against its standards. So before I hand over to Dennis to talk us through some maybe more specific measures, I'd say that the starting point for firms really is to do a gap analysis of where their systems and controls framework is now against the new rules. And the devil here really is in the detail. Some rules, first glance, look very familiar, but then you dig into it and you see that the FCA is just subtly extending requirements and it's adding some new things to consider, particularly, for example, in some of the new conditions around appointing third parties.
Yeah, and you're absolutely right, Olivia, that some of the oldest things that you've pointed out. And as you say, the clock is really ticking now with only 5 months to go. The industry has asked the FCA for more time, and the FCA has granted more time. And effectively, the grace period is now over, as we're 5 months into it remaining. So by now, firms should really be deep into performing the gap analysis as well into implementing phase as well, in terms of implementing any changes that's required. So from my experience, firms that are handling this well are really focusing on 5 key areas, and I'll go through them in turn. Firstly, it's all about the people. You've got to know who is responsible for which areas. And this is all about assigning clear accountability within the firm. And it's not one person's job, really. You're talking about getting treasury, finance, legal, whether it's product, engineering team as well, all on the same page in terms of what needs to be done. So if you're a firm that's not already assigned responsibility to a safeguarding officer, now's the time to do it. And if you haven't got a committee set up to look after safeguarding or CAS, now is also the time to do it. Secondly, it's really board oversight. That's really key as well. And this one is huge because if your board is not on board to understand the impact, how would you actually carry forward the necessary changes that's required? So you have to think about how they're actually being kept informed on progress. More importantly as well, how do they actually get assurance that the systems, the processes, and the controls that they're implementing will actually work when it comes to May 2026? I'll also look in at this time the 3 lines of defense. So what is the role of third line? What's the role of internal audit? Do they have the expertise to carry out or to provide this assurance to the board? Or do they actually need to bring in external experts, for example, to really pressure test the work that's been done and ensuring that when they go live, they're actually in compliance with the rules. Thirdly, you also need to have a complete capture of a CAS footprint, I think to the point that you've mentioned earlier. So basically, you need to have a documented trail showing exactly how these new rules will actually apply to your firm, specific to your business model. So you have to map out the flow of funds, look at your permissions. It's just really all-encompassing, really. Auditors sometimes refer to this as the rules mapping. Once the foundation is set in place, and importantly, it's been signed off by your safeguarding officer, that your footprint is complete, you could then start finding the gaps. You can finally see where your current processes fall short, for example, or what sort of new systems you need in place, and what you need to build. And some of the more especially tricky areas like the D+1 comparison, so that's new, as well as changes that's required to your internal reconciliations. Fourth, and I think this is probably my favorite bit because I was an ex-auditor myself, documentation. So one of the auditor's mantra, if you like, is if you haven't got it documented, have you really got it done? It didn't happen really if you haven't got it written down. So that's the key to being audit ready. It's all about how you could actually prove that you've met your obligations. What can you actually physically show someone to evidence it? It could be the training logs, if you've done training for your firm, for the team members to ensure that they are upskilled. It could be committee meeting minutes, for example, to evidence that the due diligence that you've done on banks have actually been tabled to the right stakeholders. And it's all about creating what the auditors will like to call the audit trail or the paper trail. Historically, one of the tough areas to comply with, or to evidence rather, is automated controls. Because it all happens in the system, firms really have to think about it right now in terms of how or what would they actually show to the auditors to prove that the systems and the automation are all working. Finally, number 5 is a well-run regulatory change program. This is a big regulatory change for the payment sector, and it cannot be a side of desk job for a single person. You need a proper project with all the key decision makers in place, the stakeholders at the table. It's really to ensure that the right people are making the right calls at the right time. So this group will be prioritizing tech changes, for example. I'm sure there'll be competing priorities in the book of work, assessing the impact potentially on the firm's liquidity, for example, or even just selecting the right CAS auditor, for example. So the project change team is really there as a central hub to bring all of these things together.
Thanks, Dennis. And reflecting on those 5 key areas, Olivier, from your perspective, what do you see firms struggling with the most right now?
So Dennis is quite right. The new rules do bring challenges to payments firms. And I think maybe what we've actually seen is that many of these have now become more on the operational side rather than sort of questions of strict legal interpretation. People are now starting to get more into the weeds and put together those sort of regulatory change programs where necessary. I think, to take an example, under the new regime, firms are going to have to consider diversification as part of their due diligence. And I think there, when it comes to safeguarded accounts in particular, there is an open question about whether there are actually enough account providers out there, which would obviously limit a firm's ability to diversify. And that's not even really to mention the point that actually opening multiple safeguarding accounts with a variety of banks is quite expensive to do. And then another big exercise just to mention is the resolution pack requirement. So the resolution packs are sets of information that are intended to help with the winding up of a firm. The FCA said that it expects these to be living documents. It expects these documents to link directly out to the latest records. And I think when the sort of consultation paper and then the follow-up policy statement came out, a lot of feeling in the industry is that the FCA has perhaps maybe underestimated the sort of time and effort that it would take to put together these documents. And we certainly know that some firms have drafts of these documents put together, or at least first drafts, but there's still quite a lot more needed to do to bring together all of the relevant documents in the right place and also test that they can be accessed at quite short notice. And then perhaps the third topic, and perhaps it sounds like one of Dennis's favourites, is the safeguarding audit, so the annual audit requirement. Some firms do these already. It's an FCA expectation at the moment. It's now going to be a strict requirement, and that is really, really the step change there. These audits bring their own cost if you think about it, because you've got to find and appoint a specialist auditor. You've got to do a lot of work upfront to get yourself audit ready. And then when you get the report back, if it's got any sort of concerns that need addressing, you then need to address those. And I think one of the concerns that's sort of bubbling along out there is that actually the cost of these audits for maybe the much smaller firms might be prohibitive. So I think those are really the three key areas that I pick up on.
Thank you, Olivia and Dennis. It's clear that safeguarding isn't just a regulatory box-ticking exercise. Let's now move on to reimagining safeguarding as a business enabler. Dennis, I'd love to hear your thoughts on how organizations can use these changes to challenge the status quo, enhance governance, and drive sustained change.
Yeah, no, that's absolutely key. So we mustn't forget that all these payment firms are running a business in the end of the day. So it just happens that they are actually running this business in a highly regulated sector. So commercial reality will always come into play. But having said that, protecting client funds and making sure that consumers are protected is the absolute foundation for building trust in the industry. And it's across the whole financial sector, not just the payment sector. So while it's easy or maybe to really look at it as a regulatory burden, it's really how do we actually turn this around to look at it as an opportunity, if you like. And it's a chance to challenge the status quo on how things are currently done. I think the opportunity to ask the question or to challenge the mindset that we've always done it this way, but is that the right way to do it now, given there's more clarity from the regulators, for example, and an opportunity to really genuinely enhance firms' governance and control environment. So that can only benefit the firms in the long run, in my opinion. And here's the commercial link. I can tell from conversations with my other clients, which are in the investment firm sector, that are using PSPs right now. They will be asking the tough questions to these PSPs in terms of how they are stepping up to comply with these new rules and how they are then keeping effectively their customers' monies with these PSPs safe. So as part of their own due diligence, they'll be asking, how have you complied with the rules? Show us your controls. So it is now a business imperative for these PSPs.
Absolutely. Dennis, you touched on board and executive oversights earlier. So let's consider their perspectives. Olivia, what should boards be asking or challenging in relation to safeguarding?
So that's a great question. I'd say that as a starting point, boards need to ensure that they're comfortable that they've got a clear and robust set of safeguarding policies and procedures in place, and importantly, that those particular procedures are actually being followed in practice. So to take an example, There should be a very clear policy in place setting out the due diligence that should be done on third parties holding safeguarded funds or assets, and also when that due diligence should be refreshed. And boards will want to be comfortable that the due diligence is going to be sufficiently thorough, given the really important role that those third parties are going to play. Then coming back to the sort of point about safeguarding audits. So those are a really important element of board oversight of safeguarding. They're important in the sense that they're actually part of how boards will get assurance that the safeguarding framework that a firm has is working as it should be, and also are there any areas that should be improved. And I think that when boards are involved in that process or boards get those reports, they shouldn't be afraid of challenging those reports in the sense that if they feel that they're maybe not detailed enough or perhaps not robust enough, just sort of digging down into that extra bit of detail. And then I think the other point, and it's a point that Dennis has touched on before, is the people, the individuals. So boards need to ensure that an appropriate safeguarding individual is selected. And in some organisations, we know from sort of speaking to various people in the industry, actually the right person is relatively obvious. And we know that many firms have worked out who that should be, but perhaps not all firms have already lined up that relevant person. And that person needs to be a director or a senior manager, but they also have to have the sufficient skill and authority to have proper oversight for the firm's compliance with the safeguarding regime. So two really important elements. And I think the third element there is that individual also needs to have the authority to be able to keep safeguarding on the board agenda. So that goes back to the sort of real importance of that seniority point, alongside having the sufficient operational knowledge to keep the board informed. So I think those are key areas, I think, for boards to be thinking about.
Okay, thank you. Now let's turn our attention to the role of the regulator. Olivia, could you start by sharing what the FCA's main concerns have been around consumer harm? And also walk us through the supervisory tools that the FCA has at its disposal, including any notable case studies or historical finds that could help set the context.
Of course. I mean, as you say, the FCA's focused on preventing consumer harm and perhaps more broadly customer harm in this space. And a key objective of these new rules is ensuring that funds are returned quickly to customers if a firm ends up in the unfortunate position of failing. The FCA has been quite clear in some of the papers that it's released that it's going to consider the supplementary regime to be a success if there's a decline in the percentage of shortfalls of relevant funds held by failed payments firms, and those shortfalls are driven by non-compliance with safeguarding requirements. And then the other marker for success that the FCA said publicly is if there's a decline in supervisory cases relating to deficient safeguarding practices and procedures. And I suppose that leads me on to what are the range of supervisory tools in this space that the FCA can use. So most firms will already be pretty familiar with some of these. I mean, you've got private warning letters, you've got restrictions or requirements on firms' business models, you've got quite extensive investigatory powers, and then, of course, ultimately the ability to impose a fine or perhaps to strip a firm of its licenses. There have been some quite large cash fines in the past, and I think that's partly because the quantum for calculating the fine is in part based on the value of the assets in custody. And one other area to mention there is that when it comes to cash fines, there is no actual need for the FCA to show that assets have actually been lost. But I think just looking ahead, it seems much more likely that the FCA's preferred approach in enforcing in this area, at least in maybe the short to medium term, is through tools such as VREX or voluntary requirements. So to take an example, the FCA might ask a firm to sign a voluntary requirement if it feels that the firm has issues with its safeguarding controls. And the potential limitation might be that the firm is not allowed to take on new business until it's rectified those deficiencies.
That's a great overview of the regulatory landscape and the FCA's actions so far. Let's look ahead to what happens after the May 2026 go-live date. Dennis, could you talk us through what firms should be focusing on post-implementation?
Yeah, sure. And I think on this point, I think it's important to remember that the May 2026 go live date is not the end of the journey. That's only the beginning of the journey. So firms really need to keep embedding down the new controls, the new governance framework that they've put in place. For example, continuously monitoring that everything's running as expected, especially the internal controls. And really up until the first audit, which for most firms will be early 2027. And just to emphasize, firms are not doing this for the audit, to tick off the box. And they're doing this for the purpose of consumer protection. And the audit is nevertheless an important milestone. And let's be honest, errors, breaches, or near misses will occur throughout the journey. It will happen. And the key thing here is that there is no materiality when it comes to these issues. Whether it's an error of 1 penny or 100 million pounds, it needs to be captured and understood by the firm. And to understand the error is what I guess auditors again will look for are things like root cause analysis. Do we understand what has caused the error and what remediation actions are the firm putting in place to ensure that it doesn't occur again?
And Olivia, it'd be helpful to hear how the FCA will monitor firms' monthly submissions and what will they be looking for in terms of risk to consumers?
Sure. So I think maybe as a starting point, monthly returns will give a lot more data for the FCA to process about how firms' businesses are getting on. And sudden changes in either direction really could raise concerns. So to take an example, if there's been a really rapid period of business growth for a firm, that might trigger some questions around the firm doing certain things to make sure that its control framework grows with that particular spurt of business growth, to put it that way.
Yeah, I think it's also worth noting that although firms are the ones that's implementing all of these changes, it's not just them under pressure right now, actually. It's also the auditors. So the auditors will be going through full preparation mode right now. They'll be developing their own audit programs, for example. They'll be making sure that there's enough staff that's being trained to actually deliver these audits. It is a specialist audit, as you mentioned earlier, as well. And really making sure that everyone's upskilled. And then next, I guess, on this topic of audit, the next big thing that everyone's waiting for now is the new FRC standard. And we're hoping that some guidance is going to be published before the May 2026 go live. So we'll need to watch this space because this will provide much needed clarity. And I guess if we fast forward, in time, the first batch of these new safeguarding audit reports will land at the FCA's desk, probably second half of 2027. So it seems like a long time away, second half 2027, but you'll be sure that the FCA will be waiting for those reports and they'll be reading every single one of those reports as well when it arrives. And here's a hopefully useful insight for everyone as well. So the FCA has got its own KPI when it comes to audit reports. The expectation is that not more than 10% of the reports that they receive will be adverse opinions. An adverse opinion actually means that it's effectively a fail on your report card. So firms don't want to be in that territory, for example. So that's interesting to know in terms of how the FCA actually measures performance of how the industry is actually complying with these new CAS rules.
Interesting. So we're nearly at the end of today's podcast, but before we sign off, I'd love to hear any final thoughts or key takeaways from Olivia and Dennis.
Thanks, Yalini. I think a key message here is that these rules, they're not a seismic change in the way that perhaps the end state, or as they're referred to now, the post-repeal rules might have been. But I think as we've demonstrated here today, as we've been talking, these rules are going to require work to comply with, and they're quite a tangible example of how the FCA has high regulatory expectations in this area.
Dennis?
So we've covered a lot. So there's a lot to take in, I think, for regulated firms. But I think to wrap it all up, expectations are high. In the sense that the FCA has done their roadshow. They're being as helpful as they can. They've listened to the industry as well. The industry has asked for the extra time. They've been given the extra time. So therefore, I think the message is clear that there are no excuses from this point onward for firms. And this is not just about, I guess, the regulated firms or the FCA or the auditors as well. I think firms will need to remember that their own customers will have expectations on how they'll be embedding these rules. As I mentioned earlier, be ready for those due diligence from your customers. So firms are really getting the pressure from all fronts, the auditors, the FCA, as well as their own customers on this basis.
Very helpful. And that brings us to the end of today's podcast. And one of the main key takeaways is that safeguarding isn't just regulatory box tick. It's really about building trust and setting your business up for long-term success. The new rules might feel like a lot, but they're also a chance to strengthen your governance, get everyone on the same page, and show our clients and partners that you're serious about doing things right. Now, with the deadline coming up fast, now's the time to get those gaps closed and make sure your boards and teams are fully engaged. So I want to say thank you again to Dennis and Olivia, and to all of you for tuning in. If you've got any questions or want to talk about everything we've covered, please do get in touch. Bye for now.
To access more podcasts, videos, and articles, go to thepaymentsassociation.org.